All right, I found 5 Canadian ETFs that pay between 11 and 43% every year. So if you put in $100,000 into these funds with $20,000 in each, you'd get about $1,591 every month. That's $19,090 per year in cash payments. And these are perfect if you want money coming in now instead of waiting 20 years for retirement. So the first one we have is MSTE, the Harvest MicroStrategy Enhanced High Income Shares. MSTE focuses entirely on MicroStrategy, a business intelligence company that has converted most of its treasury into Bitcoin holdings. The fund owns MicroStrategy stock and writes covered calls on it to generate income. Since MicroStrategy's stock price moves significantly with Bitcoin prices, the options on this stock command higher premiums. So this creates the potential for substantial income, but also means that your investment value will fluctuate considerably with cryptocurrency market movements. MST pays about 43.3% per year. So if you put in $20,000, you get $722 per month. And it's important to note that MST is an extremely new fund launched in March 2025. So it has no long-term track record. So we really have no idea how it will perform over the long term. And really quickly, I've noticed that more than 80% of you who watch these videos aren't subscribed. An easy way to support this channel and help it grow is by hitting the subscribe button below. All right, second is QQCL, the Global X Enhanced NASDAQ 100 Covered Call ETF. QQCL owns 100 largest non-financial companies on the NASDAQ exchange. These include technology leaders, biotech companies, and consumer services. Because these companies tend to have higher stock price volatility, their options generate higher premiums when sold. This fund uses the same covered call strategy, but on more volatile underlying stocks, which allows for higher income generation. QQCL pays about 14.2% per year. Put in $20,000 and you get $237 per month. Now the third one is HMAX, the Hamilton Canadian Financials Yield Maximizer ETF. HMAX focuses on Canada's biggest financial companies, including major banks, insurance companies, and other financial services. These companies consistently generate profits and pay dividends to shareholders. HMAX takes these dividend-paying stocks and writes covered calls on them to boost income even further. This fund pays about 13.6% per year. If you put in $20,000, you get $227 per month. And as a Canadian investor, you also get preferential tax treatment on Canadian dividend income through the dividend tax credit. Now, number 4 is HYLD, the Hamilton Enhanced S&P 500 Covered Call ETF. HYLD owns the same 500 companies as the S&P 500, but it just uses covered call options to generate additional income. The fund owns stocks and then sells call options on those stocks to other investors. When someone buys a call option, they pay the fund a premium. This premium becomes your monthly income. HYLD pays about 12.8% per year. So if you put in $20,000, you get $213 per month. And this fund is protected from currency changes because it's hedged to the Canadian dollar. Number 5 is HDIV, the Hamilton Enhanced Multi-Sector Covered Call ETF. HDIV spreads investments across multiple sectors of the economy rather than concentrating in one area. This includes financial services, utilities, technology, healthcare, consumer goods companies. The fund selects dividend-paying companies from each sector and applies the covered call strategy across this diversified portfolio. This approach provides more stability because poor performance in one sector can be offset by better performance in another. HDIV pays about 11.5% per year. Put in $20,000 and you get $192 per month. And here's what you'd receive every month with a $100,000 split evenly amongst the 5 funds. MST would pay you $722 per month. QQCL would pay you $237 per month. HMAX would pay you $227 per month. HYLD would pay you $213 per month, and HDIV would pay you $192 per month. Your total income would be $1,591, which equals to $19,092 per year. And these payments can change every month because they depend on option premium levels, which fluctuate with market volatility and other factors. Some months you might receive more than these amounts, other months less. And you have 3 main strategies for allocating your money. Strategy 1 is to keep it simple. Put $20,000 in each fund. This gives you maximum diversification across different approaches and is the easiest to manage. Strategy 2 is to play it safer by putting more money in HYLD, HMAX, and HDIV while reducing your positions in QQCL and MSTE. This provides more stability but potentially lower income. And strategy 3 is to focus on higher income by overweighting QQCL and MSTE since they pay the most, but this increases your overall risk. You need to understand that these payments change on the regular. The money you receive each month goes up and it goes down based on market conditions. This isn't like a salary that stays the same. Additionally, these funds can lose value. You might collect $1,591 per month, but your original $100,000 could be worth $90,000 or $110,000 depending on how the underlying stocks perform. And to buy these funds, you need a Canadian investment account with a broker such as Questrade, TD Investing, or other Canadian financial institutions. And if you want to calculate these profits yourself, remember to check out the free profit calculator in the description or the first pinned comment below. Now, in Canada, most of the income from these covered call strategies receive favorable tax treatment as capital gains rather than regular income, which means you pay less tax. To get started, begin with a smaller amount than you think you need. Don't invest $100,000 immediately. Try $10,000 first to see how you feel about the monthly payments and price movements. Set up automatic dividend reinvestment with your broker so your monthly payment automatically purchase more shares. Then check your allocation once per year. And if the fund has grown much larger than the others, sell some shares and buy more of the smaller positions to maintain your target allocation. And most importantly, do not panic when your account value moves up and down. This is normal. Focus on collecting the monthly payments. These Canadian covered call funds can provide real monthly income, but they're no magic solution. You're choosing to receive income now instead of potentially earning more money later through pure capital appreciation. The payments you see today might not be the same tomorrow because market conditions constantly change. This approach works well if you want income now rather than waiting decades, and Canada provides better tax treatment than most other countries for this type of income. So choose the allocation that feels right for your situation, understand that things will change over time, and stick with your plan for the long term. And now watch these two videos for more investing tips.